Oklahoma State Extension's Derrell Peel is our cattle market analyst this week. The U.S. produced a record amount of red meat for the month of September and 2% more beef than a year ago. As you'll hear in a few minutes, that excess output has been supported by demand both domestically and internationally. American shipments of beef and veal in August logged their highest total in more than 4 years, led by Japan and its best month since October 2003. The U.S. Department of Agriculture is projecting exports for 2017 will be 11% better than 2016, but still below the world's top 3 sellers. The agency's latest cattle on feed report indicates supply should be plentiful. The overall inventory at the beginning of October was 5% higher than last year, and placements during September were up 13%. We talked with Derrell Tuesday morning about market prices and beef trade, but we began by asking for his thoughts on the USDA's cattle on feed estimates.
Well, obviously we've got more cattle out there. We placed a lot more cattle in September, and that pushed the on-feed inventory up to a little bit over 5% year over year. Placements were pretty close to expected, but marketings were pretty close to expected, but that placement number was certainly bigger than generally anticipated.
It's not the first time that the pre-report guesses on placements have been lower than what the actual number turns out to be. Why has there been such a hard time deciding where the number is going to come in?
Well, placements are always more challenging to estimate. We have the widest range typically, and these estimates did fall within the range of a couple of analysts in terms of published pre-report estimates. So it wasn't a total surprise, and I know amongst analysts there was quite a bit of talk going into the report that the number was going to be bigger, but there was a lot of variation in sort of feelings about how much bigger. So in one sense, it really wasn't that big a surprise. I don't think anybody was, really startled that this one came in bigger than even the average estimates. It's difficult, especially as you think about different regions of the country and who's placing cattle when and what size of cattle and so on.
And the market reaction was fairly tame?
It was, surprisingly, after some of the reaction we've had in recent months, and the fact that we've had a real strong run-up recently over the last several weeks in futures markets. I thought we might be poised for a bit of a correction based off this report, but the reaction actually seemed to be pretty mild. I think the market's kind of taken it in stride.
Surprised at overall how well prices have held in here?
Really am. I think in a very big picture since 2017 has been a pleasant surprise. Certainly this fall, as we've looked at feeder cattle prices, they've held up very well. Calf prices, at least in Oklahoma, have dropped less than half of the normal seasonal amount, really very little at all. We may see more pressure here in the next few weeks before Thanksgiving as we get into the fall run, but feeder cattle prices are actually higher now than they were, say, back in August. Counter-seasonally, and so they've held it very well. Of course, that speaks to the demand that feedlots had in terms of those big placements in September.
Can you explain what kind of environment this price scenario creates for cow-calf producers or stockers?
Well, I think given where we are right now, cow-calf producers are looking at, probably better than expected prices, and I do think there's an opportunity for some decent profitability. Obviously, there's a challenge here to manage costs. The margins are not big, but I think there's certainly potential for margins for those producers that are staying on top of their costs. For the stocker producers, even though calf prices and the purchase prices have stayed fairly high this fall, given the strength we've had for the futures markets and feeder cattle prices in general, there's actually decent margin opportunities here for stocker producers as well, and an opportunity really to lock that in and reduce some of the risk associated with these stocker enterprises over the winter.
In the feedlot, are there opportunities there as well?
Surprisingly, they've held up reasonably good. Margins have certainly tightened up here in the second half of the year for feedlots. They have bid up these feeder cattle prices, somewhat squeezing margins, but again, the strength in the live cattle futures for the spring has come at least close to providing a decent opportunity. Again, there's variation from feedlot to feedlot, so that's helped them go ahead and support these stronger prices. I think there's probably a lid on feeder cattle prices relative to fed cattle potential here, or feedlot potential, but so far it comes pretty close to working.
What does the competition look like here in the U.S. with meat demand when it comes to beef versus chicken versus pork?
Well, we know there's ample supplies out there. Obviously, beef's kind of leading the way right now, but pork production's up. Poultry production is up, not too much, perhaps, and we've shaved it back a little bit as we've gone through the year. But the bottom line is there's ample supplies of meat out there. And from a beef standpoint, I think the demand has clearly been the key in 2017 to making it a better than expected year. We've seen these retail beef prices hold very well. For the most part, wholesale beef prices have held pretty well. They did slump during the summer and have recently started to rebuild a little bit. And again, that has been somewhat of a surprise given the opportunities there are for other meats in this market.
Well, and foreign demand has been really strong too, right?
Absolutely. Our trade picture has continued to support the domestic market. It's moved a lot of the increase in production offshore with about a 14% increase for the year to date in exports in total. We were up about 12% last year. So the exports continue to help. Imports have been down most of the year. The last couple months we've actually seen year-over-year increases on a monthly basis. So we're narrowing down that, but the net effect here is still very positive on the trade picture.
Can you explain why Japan has been able to hold in strongly even though there's higher safeguards in place for frozen beef there?
Well, we didn't really know what to expect with the higher tariffs in Japan for the frozen beef. Well, one question was how much we could switch around between frozen and fresh beef, which wasn't subject to the safeguard tariffs. That's one issue. The other one is we just really don't know how strong demand is. So you raise prices, you expect some impact, but apparently the demand is such that at these levels we still don't see a lot of impact, at least not yet.
Well, describe for me the overall world trade for beef, the other competitors that the U.S. is going against.
Well, the global situation, obviously, in terms of exporters, India and Brazil are the two biggest. Australia's number 3, U.S. is number 4, and that's the way they're projected to go for 2018 based on the latest Foreign Ag Service estimates. India and Brazil are very close to tied. India has been the leading exporter the last couple of years. With some of their internal issues in India, they've sort of flattened out. They're kind of holding steady, not seeing the growth that we had seen before on the exports. Brazil, of course, has had some issues as well with their food safety problems and some of their other corruption issues in the industry there. So both of those are kind of holding steady going forward. The U.S. is expected to continue to see some growth, at least modestly, in exports as we go into 2018.
To close out with, I'll ask for your price forecast here back in the U.S.
Well, I think in a general sense, as we move into 2018, we know on the supply side that we're going to see increased beef production. That's going to continue to apply that pressure. And so I guess our overall expectation for cattle prices, both feeder and fed cattle, is what I would call modest price declines, probably in the range of plus or minus 5% or 5 to 8% perhaps. Not terribly, not huge discounts or a huge need for adjustment as we go forward. It really hinges on the demand. If the demand continues strong, we can hold it to that or perhaps even keep it to less than that. But if we should see any faltering in demand, either domestically or internationally, then we're subject to more downside risk because the supply pressure is certainly going to be there through 2018 and really all the way through 2019 into 2020.